Right now, everyday people are paying basically $5 a gallon for diesel just to get their groceries delivered, while tech companies are literally drawing up blueprints to shoot data centers into space.
Yeah, it's completely wild.
It is. Welcome to the deep dive, everyone. We are really thrilled you could join us today. So our mission for this session is to make sense of this massive stack of sources from March 2026 that, honestly, on the surface, they describe two entirely different planets.
Right. It is a profound, almost jarring disconnect. So to give you a high-level map of the landscape we're about to explore today, we're going to look at how the current geopolitical crisis is reshaping the physical economy.
Which is super messy right now.
Exactly. It's twisting our energy markets in ways we haven't seen. And from there, we'll examine how consumer behavior is rapidly mutating to cope with these pressures.
Yeah.
And finally, we will unpack why the artificial intelligence industry seems to have entirely decoupled from the economic reality that, the rest of us are actually living in.
Right. And this matters to you, like to the person listening right now.
Yeah.
These aren't just abstract headlines rolling across a ticker on your TV. The sources we're diving into today explain exactly why your gas bill is jumping, why your stock portfolio is behaving so erratically, and even why your weekend thrifting habits look the way they do right now. I mean, it is all deeply connected.
It really is.
So let's start with the most immediate friction point you're probably feeling, right? The price at the pump, the conflict involving Iran is currently driving global oil prices much higher. We're seeing a profound supply shock.
We are.
But here's the part that feels like a glitch in the matrix to me. U.S. gas averages are spiking right now, despite the fact that the United States is currently producing record amounts of oil.
Yeah.
So how does a country swimming in its own oil end up paying a massive premium for it?
Well, you really have to look at the massive multi-billion-dollar mechanics of our energy infrastructure.
Specifically, how our refineries are engineered. Because the U.S. pumps out a tremendous amount of what's called light sweet crude, and that comes mostly from our shale basins.
Right.
But a vast majority of our domestic refining capacity, especially down on the Gulf Coast, well, it was built decades ago. And it was built to process heavy, sour crude that we import from overseas.
Okay, wait. So it's like having a pantry completely full of canned food, but you're starving because you don't actually have a can opener?
It's close, but it's maybe more like having a giant silo full of raw, unprocessed wheat when your bakery is strictly built to only process fine flour.
Oh, I see.
Right? You can't just dump the raw wheat into the flour machines without completely breaking them. It's a massive physical supply chain mismatch.
Wow.
So to process our own light crude, we would need to retrofit those refineries. And that takes years, not to mention billions of dollars in capital.
So we don't do it.
Exactly. Instead, we export our light crude and we just rely on importing the heavy crude.
So when the Iran conflict disrupts those global flows of heavy crude, our refineries get squeezed. And naturally, that cost passes directly to the consumer. Meanwhile, you've got energy majors like Chevron and ExxonMobil, and they are actually posting incredible numbers right now.
Because the global price of crude is staying above $100 a barrel.
Exactly.
And man, this energy shock, it is bleeding into absolutely everything else. Because of this persistent inflation, the Federal Reserve's prospects for cutting interest rates in 2026 have seriously dimmed.
Yeah, totally.
Like the futures pricing is now pointing to a prolonged hold. And we're even seeing whispers of rate hikes again, which is wild. Mortgage rates have ticked back up, labor data is softening, and diesel prices, they just topped $5.04 a gallon.
Which is rough.
It's the highest we've seen since 2022. And our sources say that's largely because disruptions in the Strait of Hormuz are triggering massive transport surcharges across trucking, rail, global shipping, all of it. So let me ask you this. If diesel is essentially the blood of the physical economy, how fast does a $5 price tag actually translate to higher prices in our online shopping carts?
Oh, instantaneously.
Really? Instantaneous?
Yeah, because freight companies don't just absorb those costs out of the goodness of their hearts. They apply fuel surcharges immediately to protect their margins.
Oh, okay.
And this really deepens what economists call the K-shaped economy.
The K-shaped economy.
Right, think of the letter K. One trajectory is going up and the other is going down. These higher diesel prices, they act as a highly regressive tax on lower-income households.
Because everyday goods cost more.
Exactly. The pass-through costs of shipping hit low-margin, essential goods like your groceries. the absolute hardest. So it widens inequality and severely threatens overall base consumption.
Okay, but looking at our sources, the corporate world seems to be absorbing this inflation in a way that kind of defies logic.
How do you mean?
Well, despite all this oil volatility and inflation we just talked about, the S&P 500 actually closed higher.
Mhm.
And travel names are wildly outperforming right now.
Oh, right.
Like Delta Airlines and American Airlines just raised their first quarter revenue outlooks. They're reporting robust demand, incredibly strong premium bookings, and they're saying their loyalty programs are completely offsetting the higher fuel costs.
Well, see, this is exactly the upward arm of that K-shaped economy I was just talking about.
Okay.
The premium consumer is remaining incredibly resilient right now. They're effectively ignoring the inflation that is actively crushing the bottom half of the economy.
I have to push back on that, though. I mean, if lower income and even middle-class consumers are getting completely crushed by gas prices and grocery inflation, isn't there a ceiling to how many business-class airline tickets the top tier can buy to prop up the entire economy?
You'd think there's a ceiling, definitely. But you have to realize the sheer concentration of wealth at the top of that K-curve. Airlines aren't relying on the middle class treating themselves to a summer vacation anymore. They're relying on corporate accounts and high net worth individuals who literally do not look at the price tag when they book.
Oh, wow.
Yeah, the top 20% of earners account for a disproportionately massive share of all discretionary spending, and corporations are leaning heavily into loyalty programs just to build a walled garden around these premium customers.
Keep them spending.
Exactly. But I will say you are totally right to question the sustainability of it all, because we are seeing severe cracks in companies that cater to the middle of the market.
Like who?
Look at Lululemon. They just issued weaker than expected 2026 sales and earnings guidance.
Right, I saw that. They cited tariff headwinds and significantly soft sales in the Americas, though I think international growth is still a bright spot for them.
It is, yeah.
But they're also dealing with a proxy fight, right? Like, activist investors are essentially trying to force changes on the board of directors because they feel management is fumbling their core consumer base. And then you look at a company like Six Flags, their stock popped recently, but not because their amusement parks are actually doing
I
great.
love it all.
It popped because activist investor Jana Partners is pushing for a full sale of the company. Because Six Flags has high leverage, meaning they have a ton of debt, and Jana wants them to sell the entire enterprise, rather than just slowly selling off individual parks to survive.
And that ties right back to what we said earlier. When interest rates stay high, going back to the Fed's dimmed rate cut prospects, highly leveraged companies face immense, almost existential pressure.
Servicing that debt gets incredibly expensive.
Exactly. So if you're an amusement park and your whole model relies on middle-class families, well, if those families are suddenly priced out of a summer road trip by $5 diesel,
Yeah.
your business model starts to fracture.
Yeah, so if you're a highly leveraged company, you're looking for an exit strategy. And if you're an institution trying to survive this kind of global instability, you're looking for entirely new systems.
Oh, absolutely.
Because with traditional physical markets behaving so unpredictably and geopolitical tensions just boiling over, we are seeing a massive scramble for alternatives. Institutions are finding totally new ways to hedge risk and move capital.
Right.
Like on the most literal level of global conflict, Elbit Systems just saw their earnings surge 76%.
Wow.
Yeah. They have a record backlog because the Iran conflict is driving what they call material growth in munitions and electronic warfare systems.
Which makes sense. I mean, the defense sector is reacting to the immediate physical reality of war. But what's equally revealing to me are the defensive maneuvers happening in the financial sector right now.
Like what?
Well, MasterCard just agreed to buy a firm called VVNK for up to $1.8 billion.
Right, and BVNK is a stablecoin infrastructure firm.
Exactly.
MasterCard wants to integrate on-chain payments, so crypto transactions that settle on a blockchain, into its global network. They want this for cross-border remittances and B2B or business-to-business use cases.
Yeah.
It's almost like MasterCard is trying to build a universal translator between traditional fiat money and crypto, right when cross-border stability is desperately needed.
That is exactly the utility they are buying.
Yeah.
I mean, think about a traditional cross-border wire transfer using the legacy banking system.
Oh, it's a nightmare.
It really is. It has to hop through like 3 or 4 different intermediary banks. Each one is taking a fee, and it can take days to finally settle in the account.
Right.
But a stablecoin transaction, it's like handing a digital $100 bill directly to someone across the globe and it settles in about 3 seconds.
3 seconds. That's incredible.
Yeah, so in a world where the physical flow of goods is constantly disrupted by conflicts and tariffs and gas prices,
Mm.
there is a massive premium on making sure the digital flow of capital is totally frictionless.
Which is a stark contrast to our physical logistics.
Completely.
Just look at the U.S. Postal Service. They just issued a really stark warning that they could literally run out of cash in under a year.
Unbelievable.
Yeah, they are begging Congress for reforms to their borrowing limits, their pricing flexibility, and their retiree funding mandates.
Well, it perfectly highlights the vulnerability of our legacy physical infrastructure.
Mm-hmm.
The USPS is drowning in the physical costs of transportation and labor. Meanwhile, digital money movers like MasterCard are deploying billions to make their networks even faster and lighter.
Right. And speaking of the tension between legacy systems and new models, we have a fascinating jurisdictional clash unfolding right now in the prediction markets.
Oh, this is a big one.
Yeah. Arizona's attorney general just filed a criminal case against Kelshi.
Right. So the state of Arizona is basically alleging that Kalshi is operating an illegal gambling ring by allowing users to place bets on political elections.
Okay, but Kelshi vehemently disputes these charges, right?
They do. They argue that their event contracts are financial derivatives, and therefore they fall strictly under the federal jurisdiction of the Commodity Futures Trading Commission, or the CFTC.
Okay, so just to pause here for a second, to be completely fair, we aren't here to play judge and jury on whether Kelshi is a gambling site or a legitimate futures market.
No, definitely not.
We are explicitly not taking sides on whether event contracts should be federally regulated or considered illegal gambling under state law. That's a legal turf war for the courts to decide between the state and the federal government.
Exactly.
But purely from an economic standpoint, the fact that people and institutions are flocking to these platforms to bet on specific geopolitical or electoral outcomes, I mean, it shows how desperate everyone is to hedge their risks in a world that feels completely unpredictable.
Yeah, it's an attempt to buy certainty.
Right.
When traditional equities feel divorced from reality and physical logistics are failing, capital just looks for alternative ways to forecast the future.
And that desperate need to predict and control the future is exactly why so much capital is fleeing traditional physical markets right now.
Where's it going?
It's pouring into the one sector that promises absolute technological certainty: artificial intelligence. Ah, of course.
Yeah, the tech sector right now is operating in an alternate universe with mind-boggling amounts of capital. We are talking about true AI escape velocity here.
It really is. The sheer scale of capital deployment in AI makes the rest of the economy look basically stagnant.
Yeah.
I mean, Nebius Group just launched a massive $3.75 billion convertible note raise.
Okay, wait, let's break that down for a second for the listener. A convertible note raise for nearly $4 billion.
Yes. So a convertible note is essentially a massive corporate loan that can convert into equity or stock at a later date.
Okay.
They are raising this cash specifically to fund data centers and advanced chips. Now, Wall Street didn't actually love the move, to be fair.
Oh, really?
Yeah, Nvidia shares actually fell in the news because investors were worried about diluting the value of their existing shares. But you have to look at the context. It comes right on the heels of $29 billion in recent AI capacity deals involving Meta and Nvidia.
$29 billion.
Yeah. The sheer appetite for cash in this sector is bottomless. And it's driving massive organizational shifts, too, right? I mean, Microsoft just reorganized its Copilot teams under a single leader.
They did.
And this frees up Mustafa Suleyman to focus purely on frontier model development. And for those wondering, a frontier model is exactly what it sounds like. It's the absolute bleeding edge, next generation AI that requires exponentially more computing power to train than anything we currently have.
Exactly.
And meanwhile, IBM just closed its acquisition of a company called Confluent. And they did this to integrate real-time data streaming into Watsonx, which is their enterprise AI platform.
Which is huge.
Right, because they don't just want AI that knows historical data anymore. They want AI that can process the world as it happens, second by second.
Well, what connects all of these moves, Nebius, Microsoft, IBM, is the desperate, almost panicked race for infrastructure.
Yeah.
They're all trying to build the processing power and the data pipelines to support these frontier models before they hit a physical wall.
And nobody illustrates that race better than Nvidia.
Oh, definitely not.
They just unveiled their new Vera Rubin platform and their new chips, which include integrated Grok LPU racks.
Right.
And an LPU is a language processing unit. So unlike a standard graphics processing unit, an LPU is custom built from the ground up to do one thing: spit out text tokens for large language models at lightning speed.
It's purpose-built.
Exactly. And Nvidia noted that orders for their Blackwell and Vera Rubin architectures could reach $1 trillion through 2027.
Trillion. With a D.
1 trillion. But here's the detail I absolutely cannot stop thinking about. Tucked in there, among all these announcements, Nvidia announced orbital data center ambitions.
Yeah, that's wild.
So let me ask you this. Is putting data centers in space a stroke of out-of-the-box engineering genius, or is it just terrifying proof that AI's energy and cooling demands here on Earth are completely unsustainable?
Honestly, it is the ultimate manifestation of the digital world hitting the physical constraints of planet Earth.
Okay.
Because AI requires massive, unprecedented amounts of power to run. And it requires millions of gallons of water to cool the servers down.
Which we don't really have.
Right. We are running out of grid capacity and environmental bandwidth to support it. The tech industry is literally looking to the vacuum of space because the physical realities of generating power and cooling server racks down here have become the primary bottleneck to their growth.
Wow.
Yeah, think about it. In space, you have ambient freezing temperatures for cooling, and you have unobstructed solar energy for power.
That is just wild to think about. I mean, the irony is, while Nvidia is looking to the vacuum of space, down here on the actual street level, new technology is crashing into very human, very messy physical friction.
Yeah, we're definitely seeing that.
Like, how are these economic pressures actually shifting consumer lifestyles and public behavior on the ground?
Well, we are seeing a real visceral pushback in some areas. Take autonomous vehicles, for example.
Okay.
Waymo is facing serious public acceptance challenges right now. A man in San Francisco was recently charged with repeat vandalism against Waymo vehicles. And there are separate, alarming reports highlighting passenger entrapment concerns, where the car's doors simply wouldn't unlock.
I mean, it's a huge hurdle for Alphabet's robotaxi rollout. Slashing a tire on a self-driving car isn't just standard vandalism, you know? It feels like a physical protest against being forced to share the road with an algorithm.
Exactly. It's a rejection of the tech.
But while the U.S. struggles with autonomous tech, in Europe, the physical shift to green tech is actually accelerating fast. BYD, the massive Chinese automaker, is aggressively pushing its Denza Z9 GT electric vehicle into the European market right now.
Right.
And their big selling point is flash charging. They're promising to get the battery from 10% to 70% in just 5 minutes as they roll out their high-powered charging stations.
Which is, frankly, brilliant. Because it directly targets the main physical friction of EV adoption, right?
Range anxiety.
Range anxiety and just the sheer boredom of waiting 40 minutes at a charging station in a random parking lot. They're trying to make the electric experience match the speed of the gas pump.
But while automotive tech races forward to solve our climate issues, we are also seeing a massive behavioral shift that is looking backward.
Oh, the estate sales.
Yes, the estate sale boom. This is so interesting to me. A massive wave of baby boomers are downsizing right now, moving out of large family homes, and it has sparked incredibly robust estate sale activity all across the country.
Yeah.
Millennials and Gen Z are showing up in droves, snapping up all these vintage goods. It's being driven by social media amplification and a huge generational push for sustainability. I mean, it's essentially offline thrifting going viral in the real world.
It perfectly captures the massive generational wealth and inventory transfer happening right now. Younger consumers who are totally squeezed by the inflation we talked about earlier, they are bypassing traditional retail altogether just to furnish their homes.
Yeah, it's fascinating. You have BYD trying to solve the eco-crisis with lightning-fast high-tech EVs in Europe, and Gen Z trying to solve it by buying dead stock from boomer estate sales in the suburbs.
It's a wild contrast.
It is. But speaking of the messy realities of the physical things we consume, we have to touch on a recent FDA development.
Right, the raw cheese situation.
Yeah, the FDA has flagged E. coli cases tied to raw cheese. Our sources show they linked illnesses across 3 states to raw farm raw cheddar.
And just to be extremely clear here, we are purely looking at the market tension.
Yes.
The FDA explicitly linked the illnesses to the cheese based on their epidemiological data. However, the company, Raw Farm, vehemently disputes that finding.
Right.
And they have completely refused to issue a voluntary recall while the probe continues. So as a reminder, we strictly remain impartial regarding the FDA and Raw Farm dispute. We aren't health inspectors, so we are endorsing neither side's claims.
Exactly. We're just looking at the facts as reported. But it really highlights how friction and tension aren't just limited to geopolitics or high-tech AI
Oh, no,
boardrooms.
not at all.
They're literally happening at the grocery store, involving the safety of our food supply and a direct pushback against institutional findings.
Yeah, so to synthesize all these seemingly contradictory signals we've explored today,
Mm,
we are truly living in a split-screen reality.
we really are.
On one side, you have a geopolitical energy shock
Hmm.
that is violently squeezing the bottom half of that K-shaped economy we talked about. Diesel is surging. Legacy logistics like the Postal Service are facing an existential cash crunch. And everyday consumers are dealing with the friction of high prices and supply chain mismatches.
And on the other side of that screen, premium consumers are keeping business class cabins completely full, defense contractors are surging on global demand, and the AI industry is raising billions and projecting trillions in orders,
Right.
operating as if the gravity of the physical economy simply doesn't apply to them at all.
Yeah, they're basically building entirely new digital rails to bypass the friction of the physical world altogether.
So, what does this all actually mean for you? I want to leave you with this final thought to mull over. If the AI industry is literally looking to build data centers in space to solve its energy constraints, while everyday shipping costs here on Earth surge because diesel just hit $5 a gallon, are we headed for a future where our physical infrastructure and our digital infrastructure don't just exist in different economies, but literally in different atmospheres? Thanks for joining us on this deep dive.